this really could be the best opportunity of your lifetime to become wealthy, a complete transfer of wealth from those that are impatient to those that are patient. Hello guys, and welcome to another video. My name's Mark, I'm an entrepreneur, property investor. I've got about £3.5 million worth of property. I've got a six-figure stock portfolio, which Tom, I'm going to show you, currently down, isn't it?
Yeah, just a bit.
And today I'm going to show you how to turn that frown upside down. That's really cheesy. I'm going to try and help you become rich in the 2023 recession. I'm going to give you some information, I'm going to give you some background, I'm going to give you some history so that you can feel confident going forward. And I think my attitude to investing is very much this. When the market goes down, I think to myself, fantastic, I've got an opportunity to buy cheap. When the market goes up, I think fantastic, I'm making money. I think it's very easy to get into the negative thought process, which is when the market goes down, oh my God, I'm losing money. When the market goes up, oh my God, I can't buy it as cheap as I used to. I've got that converse relationship. And I think that if you can apply that to investing, when you look at most successful investors who are investing for the long term, that is their mentality. That is certainly what I've heard over and over and over again. When the market goes down, what an opportunity. When the market goes up, woohoo, I'm making money. You know, it's always positivity. So why do we think that we might be going into a recession? Well, unless you're under a rock, the papers are full of it. Ernst Young is saying summer 2023, Goldman sliding into a significant recession, the BBC is full of it, the Daily Mail is full of it. We need to be aware that this is likely to be happening, and the Bank of England are not slowing down with interest rate rises, which is going to push more and more people to have less money to spend, and that's going to deepen this recession. So when all this negativity is around, we have to understand that the likely outcome is that we're also talking ourselves into a recession. When the public are scared, the public stop spending. When the public are jubilant, they spend frivolously. So we need to understand that all of this is playing into that narrative of a reduction in GDP in the UK. Now, when we look at the stock market tends to lead a recession. It tends to be on future, what's going to happen. So the S&P 500 is already 25% down, or actually it's greater than 25% down, depending on what day you're looking at this, down already from its highs. And that means it officially entered a bear market a couple of months ago. In June the 13th, it went into bear market territory. But applying my thought process again, and you know, we've got a dividend portfolio for our subscribers. If you're subscribed to this channel, if you comment down below, we're going to enter you into a draw where you could win the dividends from this month's portfolio. So Tom, whoever's commented on this video, please reply to them, let them know that they're going to be entered into the draw, make sure that they're subscribed, and those people will be in for a chance to win whatever the dividends are on that portfolio. But applying that thought process, we've got an opportunity at the end of the month to add to the dividend portfolio at cheaper prices, rather than having to pay those expensive prices but back when the highs were there. So my thought process is always like that. Now, when we look at the history of bear markets, and I think it's really important that we look at the history, the largest drop in recent times, there were some large ones in the 20s, 30s, but if we look recently, 51.93% in 2008, and that bear market lasted 408 days, a little over a year. The average drop is 35.62%, and the average bear market lasts 289 days. So when I'm looking at this and thinking about my portfolio, my position, what I'm thinking about in terms of the timings, and remember, there are bear markets, they come every 8 to 10 years. Corrections, they happen, once or twice a year. Bear markets every 7, 8, 9 years, something like that. And a correction is 10% reduction in stock price, whereas a bear market is a full 20% or greater from the recent highs. So if we're looking at the average and going 35.62%, we were 25%, depending on when you're looking at this video, we might be 28, 29, something around that. Certainly, I think yesterday when I was looking at the stock prices, we were about 28% down off the highs. And we were currently about 150 days in, something like that. If we would have an average bear market, we've got a little bit more to drop, and we should be returning back into a bull market when we come round to about March, April time next year. But stocks aren't the only way to make money in a recession. You know, you can also look at property. And I think as somebody with £3.5 million worth of property, this is very pertinent to me. 2008 to 2009, when stocks reduced by 51%, in the UK, property dropped by 15%. If I bring up a graph of stocks and property, you'll see that property never moves as vastly as stocks do because it takes a long time for those market conditions to happen. For example, if you were to sell your property today, you've got to get the solicitors involved, you've got to get an estate agent, you've got to get offers. I mean, the whole process takes 3 to 6 to 12 months. So by that time, traditionally, the bear market's over. And you want to renegotiate the price, which is why property very rarely drops anywhere near as dramatically as stocks do. That said, it's a leveraged asset and there's lots of opportunity for you to come in and buy cheap. I bought my first property in 2010. I paid $176,000 for a property that if you'd looked, I don't know, about, well, I wrote it was 179. So I paid £176,000 for a property in Erith, a 3-bedroom in a nice area, which is Zone 4 in London. And that property today is worth about £425,000. In fact, only 2 years later, the property is worth about £240,000. So we bought in a very good time in 2010 when property prices had dropped by about 15–20%. I think it was slightly more. It was a repossession and we managed to negotiate it right down. So there are deals to be had, and this is the big point, isn't it? That whilst with property, you can negotiate deals, the market, you just kind of have to buy at the market price. So property gives you this ability to be able to negotiate with the seller and try and bring down. Maybe the market's declined by 15%, but you get a further 10% off because the seller's feeling a little bit negative. That's where the advantage with property really comes in, because you can build in some extra wiggle room and some extra risk money by negotiating the price down. Today, we're not there. I've tried negotiating on some properties recently quite hard, and it hasn't really worked out. Nobody wants 10–20% below their asking. Give it 3–6 months when people are a bit more scared, maybe they will. It might be the right time to take advantage. But the stocks, they've already happened. The drop has already taken place. Plowing money into there may be one of the smartest things I could do right now. But as always, I don't know what the outcome's going to be in the next 1 to 2 years. There's lots of macro effects going on at the moment. But my thought process is very much in line with Warren Buffett and Rothschild. You know, Warren Buffett says, be greedy when others are fearful, and be fearful when others are greedy. Right now, people are fearful. It's time for me to be greedy. Rothschild said when there's blood in the streets, that's the time to buy. Again, there's blood in the streets. We are currently down over 25%. We're in a bear market. And the real importance of this is, let's say, for example, I'm just using this as a good example. When you're 50% down, if the market returned to its previous highs, you've doubled up. You've gone up by 100%, not 50%. Now, traditionally, we would say that the markets return 8 to 10% a year on average. If you can double up in a year or two, that's a massive advantage, and this is why this is the opportunity of a lifetime to create some generational wealth. But it really does depend on having the money to be able to invest. And as always, with all these videos that I put out and with everything in my life, I believe keeping those expenses as low as possible. It's the key, it's the foundation. It means you have more of your money to go into investments. And as you can see, I've done like a keep expenses low, increase the investments as much as you possibly can, and that will equal an increase in richness. Is that richness? Is that an adjective? Look it up. Look up richness, see if it's an adjective. It is an adjective. I knew it was an adjective.
Richness is the state of existing in or containing plentiful quantities of something desirable.
Something desirable. So exactly, that could be, in this instance, wealth, but it could be anything, right? And actually, wealth ties into most things. If you think about health, and most people say, I'd rather be healthy than wealthy, well, these things tend to go hand in hand. I can guarantee if you look at any of the health charts, the poorer tend to be less healthy, the richer tend to be more healthy. Life expectancy follows that trend. Lots of things follow that trend because what you put in, you generally get out. So again, I'm coming back to my original point, keep those expenses low. That's what I'm going to be doing. I'm going to be cutting back even further. I'm going to be putting every pound on suspicion. Investments, I'm going to increase that as much as I possibly can. I know this is a great opportunity for me to get money into the markets and to get those returns for years to come. And then hopefully that will increase and increase richness for me. So guys, I hope you've enjoyed this video. That's my plan. I'm certainly going to be keeping my expenses low, put as much money as I possibly can into investments. For me, it's index funds. When there's an opportunity for me to negotiate on property, I'm going to negotiate hard. I'm going to continue trying, but at the moment the market isn't quite there. Once I can get 10, 15, 20% discounts, I'm going to be buying some extra property, and hopefully all of that plan will mean that when the bear market finally comes to an end, hopefully sometime next year, I will have an increased level of richness. Certainly my plan. I would love to hear what your plan is. Stick it in the comments down below. I love hearing from you. And guys, I reply to every single one of you. So guys, give me a big like, subscribe, and I'll see you on the next video. Cheers.